Eric, thanks for joining me today. We saw the ISM February service PMI number this week come in under estimates as well. So the service sector is slowing. And you heard the intro. So I'm just kind of wondering, is the bottom in? And is now the time to start buying the dip?
Yeah, thanks, Daniel. So my framework involves tracking the direction of growth, not necessarily the absolute level of growth, but the direction, or what we call the rate of change in growth. And I brought a couple of charts with me. The first chart that you can show is the 4-panel chart that shows what I call coincident indicators. So coincident indicators don't tell you where the economy is heading. They define the current trend. So what we can see here is the 4 corners of the economy: industrial production, non-farm payrolls, real consumption, and real personal income. Every economy has these 4 corners. And again, what we're tracking is the direction of economic growth. And what we can see here is that the economic growth rate is declining across production, employment, income, and consumption. And then we got another number today, ISM services, which corroborates this view that the growth rate in the economy is coming down. Now, that doesn't mean negative growth, but it means the growth rate is slowing. Okay, so what does that all mean? That generally means when you're in a cyclical downturn in growth that you have significantly increased volatility across asset prices. And what you'll note in this chart is that the growth rate peaked in March of 2021 across basically all 4 segments of the economy. So for the past 1 year, the economic growth rate has been declining. And if investors pull up any of their charts, they'll note that around that March 21 inflection point is when everything started to change. All of the high flyer story stocks that are very common in the ARK ETF all started to peak around that point. Long-term interest rates peaked in March of 2021. So generally, when the growth rate in the economy is decelerating, which it still is, you're going to have volatility in the marketplace. So this is not necessarily a dip that I would be buying, because the growth rate is going to continue to decline, and the Fed is going to tighten monetary policy into that slowing environment. And generally speaking, geopolitics aside, that's a recipe for more volatility to come.